Thank you very much. Great session. We did run out of time. I didn't get to ask the question I wanted to ask, but I was reminded of this. I was advising some Dutch banks, and they had been, the Dutch tax authorities had essentially basically said, look, we've got a problem with dividend arbitrage. And they called in the Dutch banks and said, boys, we're giving you 1 year to sort your house out. And if you don't sort yourself out in 1 year time, we will introduce legislation. And that was designed to get these guys to start behaving. And I was at the Dutch bank at that time. And the guy flew in, he goes, we've just had a meeting with the tax authorities, and we've got 1 year to make as much money as we can. So, so anyway, that's a salutary lesson. And I think, you know, we will have a session this afternoon talking about tax integrity, which is really how does the interface work between the tax authorities and the other parts of the system and for financial services firms. You know, what does this mean? And that's really one of the things that we will be exploring this afternoon. Anyway, I'm going to invite our next panel moderator, which is Mr. Steffen Gnutzmann. If you can introduce yourself and the panel. Thank you very much.
Yes, and I would like to ask to join me up front here, Ms. Petkova, Mr. Reidy, and Mr. York. Yes, good morning, everyone. Thank you very much for joining this session. And I think in some way quite well with a good choreography. The topic of our session for 40 minutes is managing tax globally, and against the background that we just heard, lack of trust, complexity, data, I think this could be a good session. In the globalization brings higher levels of tax complexity. I think we all experience this in practice. There are heightened risks, and they pose significant issues for the taxpayers, for stakeholders in the overall process, especially in the financial services industry, but also for governments and, last but not least, for advisors and practitioners. Since the global financial crisis and one or the other, let's call it game, that has been played in tax law, as we just heard, the landscape for financial firms is significantly redrawn. I am slowly approaching 40, and I remember some games in the past which are completely out of scope nowadays. There is really a change of culture in tax law internationally. Our panel of experts will discuss how and what is being done to manage complexity in taxation in an increasingly international setting. So please let me introduce Mr. Patrick Reidy of Capital Group, based in Switzerland. Let me introduce Ms. Dr. Kunka Petkova of the German Ministry of Finance. And Ms. Dr. Petkova, thank you very much. I think it's the first time that the German Ministry of Finance is actually in London in such a seminar, at least that I know of. I don't have the full overview, but thank you very much. And last but not least, Mr. Simon York of the English Tax Authority, HMRC. Myself, I am with WTS Global, an international tax network, and we are in our team focusing on financial services tax advice. Please, Mr. Reidy, if you would introduce yourself and maybe say a few first words about our topic.
Thanks very much, Steffen. And so my name is Patrick Reidy. I'm the manager of the Fund Tax and Market Access team at Capital Group. We look after European and Asian business, so with funds in Luxembourg, Australia, and hopefully quite soon in the UK. So the experience that I have is really much in the asset management fund industry. So I'm hoping that what we speak about today can translate to other areas of the business. And if I can, if you can indulge me with a slight detour for 30 seconds, there will be a point to it at the end. So essentially, there's a little story I have where in the south of Ireland, there's a place called Blarney. And if my accent doesn't give me away, I am from Ireland. Basically, in that little place, there's a castle, and I know Mark is in the crowd here, probably knows what I'm speaking about. This castle, tourists flock from all over to go and see this castle because there's a famous stone. You need to climb to the top of the castle. You need to lean out over the edge, which is about 30 meters high, so it's quite scary. And you need to kiss that stone. When you kiss that stone, you're meant to get the gift of eloquence and persuasiveness. So there's 2 points to that story. One, I'll know at the end of this whether I need to go kiss it a few more times. And secondly, there is an element of eloquence and persuasiveness needed when you want to manage taxes globally. And that's in any organization you have. And there's a point to that I'm hoping will come clear at the end. From my perspective, managing a team which looks after a number of different funds in a number of different locations, of course, you're going to come across complexity, which is not so straightforward. In my point of view, there's a couple of different areas that you need to address when you want to manage these aspects. Some of it starts with the company that you work for, and that's around the culture. That culture doesn't start within a tax team, it starts in the company in general. And that culture can feed its way down to the teams. And why that's important for managing taxes is because, from my perspective, if the company promotes integrity, trust, accountability, analysis, things like those, that permeates through the enterprise to the tax team. Then the second thing is the people. The people are the most important part of managing taxes globally, in my opinion. I'm lucky enough to have a team of 8 professionals that have a really diverse background. Some from fund accounting, some straight out of university, some are tax professionals, some actually are more in the technology space. That, for me, is actually the requirement today, which is bringing together that diverse group of experience, that different skill set, various competencies to work together, to collaborate, to manage those aspects, because not every tax complexity you come across is the same. So you need to manage which competencies, which people will work together on each to address the problem that's at hand. The second point is around how you interact with your internal business stakeholders, your external service providers, and tax authorities and regulators. That's why we have 3 different types of panelists here today. And the last point is around technology and digitalization. On the point on navigating internally, I think it's really important when you need to manage tax complexity. It's not just the tax team's job, it's actually all of the organization. You need to understand the business priorities, the strategic initiatives that are coming up. So that tax is one of the people with a seat at the table when developing these products and these ideas, so that you're not reacting to it afterwards, but actually proactively addressing the risks that might arise. And then finally, when it comes to digitalization and the automation space, I think it's an endeavor that we all have to go through. It's extremely important to find efficiencies so we can spend time in the more complex and risky areas. However, it's really important that as tax professionals, we understand what we're automating, so that we're not just looking at an end result, but we're understanding what's happened along the chain of that automation. I think this is where I'll hand over to Kunka, who definitely sees digitalization, globalization, and from my perspective as a challenge, but Kunka will also try and explain why that's an opportunity for us as well.
Yes, and thank you, Patty. Hello also from my side. It is an honor and a privilege for me to have the opportunity to participate at this year's conference together with so many distinguished experts. Ellie, thank you very much for the invitation. I'm really delighted to be here today. My name is Kunka and I'm working for the German Federal Ministry of Finance, where I am in charge of the so-called OECD to Pure solution, addressing the tax challenges arising from the digitalization of the economy. I also deal with all tax-related topics within the G7 and G20. And as you know, we are currently having the G7 presidency, which means an even higher responsibility. Patty has already mentioned some of the challenges that we are currently facing. For instance, the digitalization of the economy and its implications for the business. In fact, the increasing digitalization of the economy and the resulting changes in value creation processes pose one of the greatest challenges to our tax administrations and to our tax systems. Why is this the case? Well, intangible assets and cross-border services allow companies to operate in countries without a physical presence and thus generate profits which they don't need to tax locally under the current taxation principles. This shows that the traditional rules don't fit the modern economy any longer. And this is why we have to change this, and this is why we need new rules. The global pandemic has made the issue even more politically present, as some businesses have been struggling to an extent that had to depend on governmental welfare, while other businesses, like the highly digitalized companies, have increased their economic success. And because of this, those companies came even more in the center of the public attention, with the clear expectation for them to pay their fair share of taxes. Especially in the current difficult times, as the integrity of our tax systems is at stake, I believe that multilateralism is still the only possible way to effectively tackle those challenges. And since global challenges need global solutions, the OECD has developed the so-called two-pillar concept on behalf of the G20. Last year in October, we had this very broad international agreement together with 137 countries and jurisdictions that represent above 90% of the global GDP. And I have to say that those 137 countries are really heterogeneous. We have big and small economies, we have developing countries, we have highly industrialized countries. Basically, we have countries from all over the world, and every single one had to make certain concessions in the interest of achieving a broader agreement, as a result of which I can say that the outcome is really quite balanced. And this agreement reflects the culmination of years of really hard work and dedication, especially in the context of the global pandemic. And it reflects bridges built on the backs of difficult compromises made across continents and achieved, of course, in the face of the challenging circumstances. But I think that all this is important because it can stabilize the expectations of both taxpayers and governments. And you all know that from an investor's perspective, reliable and stable tax policies and the predictable behavior of tax administrations are important factors for doing business in one country. Therefore, I would say that tax certainty is crucial to stimulate economic growth, but also job opportunities. So this is our agreement. I will just briefly say what this agreement is about, and then I'll give the word to Simon. So in this agreement, you have two pillars, pillar 1 and pillar 2. Under pillar 1, we have created new connecting factors so that taxation rights would to a greater extent be moved from the place of production to the marketplace, irrespective of whether there is a physical presence in the market state or not. In other words, pillar 1 aims to ensure a fairer distribution of profits and taxing rights among countries with respect to the largest and most profitable multinational companies. When analyzing pillar 1, is it important to look at the main goal, namely the stability of the international tax system. And if it's not possible to adopt a viable and internationally coordinated solution, there is a risk of a further fragmentation and further unilateral digital taxes, which could result in many trade disputes and legal uncertainty for all stakeholders. This is what pillar 1 is about, and we also have pillar 2. Pillar 2 establishes a floor on tax competition on corporate income tax by introducing a global effective minimum tax at the rate of 15%. And the basic principle of this global effective taxation is quite simple. Countries agree on a minimum level of taxation that applies worldwide. In doing so, no country is prescribed which tax rate should apply in its country. Instead, countries with a higher tax rate are given the possibility of responding to the very low tax rates of other countries, for example, by taxing back profits shifted out of the country, or by disallowing business expense deductions in the case of under taxation of the corresponding business income. I just want to underline that For us, the opinion of all stakeholders matters a lot. And this is also the reason why we had many public consultation. And every time when we publish a document, we really wanted to see what the feedback of the business community will be. So this is why, because at the end of the day, this is a very ambitious project. It's ambitious for us, for the tax administration. It's ambitious also for the business. And therefore, I believe that we can achieve and implement everything in a good way only if it's not that difficult. And therefore, at the current moment, we're basically even working on many safe harbors. But I mean, I think maybe I can stop here because I think that Simon can say a lot of things about the work of the tax administrations, the changes there, and maybe later we can talk about the possibilities and the opportunities that we found. Thank you.
Brilliant, thanks, thanks, Kunka. Look, I'm going to come at this from a slightly different perspective, but let me first just explain what I do, what my organisation does. So I head up the part of HMRC that's called the Fraud Investigation Service. That's a 5,000 strong part of HMRC that deals with serious fraud. Give you an idea of scale, because a lot of people don't know this. Over the last sort of 6 or so years since we created this, we've collected or protected around £30 billion of money for the UK. So money that was taken by tax fraud or attempted to be taken by tax fraud. And our investigations have led to a criminal conviction of getting up towards 4,000 people. So it's quite a big scale operation. The type of things we deal with, well, it ranges at one end from sort of global organized crime groups who are controlling the illicit trade in products like tobacco or alcohol, so a huge degree of smuggling, traditional sort of customs work of that nature. We deal with sort of attacks, often very digitally enabled attacks on our repayment regimes of one sort or another, and then we will deal with individuals or small groups of individuals, the super wealthy, who may look to do something to evade their taxation responsibilities, often using the network across the world. So it was my team that investigated Bernie Eccleston. You might have seen recently he's been charged with tax offences following that. So that's just give you an idea of what we do. All of those things I mentioned there, all of that work, and indeed almost everything we do has an international element to it, and that's increasingly the case. That has really quite dramatically shifted over the last decade or so, and that international nature of our work brings complexity from multiple perspectives. So I think what we've found is, and it was referenced in the last section actually, is that collaboration, international collaboration by tax administrations, but also by tax administrations with the financial sector and private sector of all sorts, is the key to unlocking that complexity, preventing fraud from happening, detecting it, and investigating it when it does happen. So there's been some real big ticket, I think, collaboration, hasn't there? So things that the OECD have done a while ago, like introducing the Common Reporting Standards, the CRS. Massive change there. In our investigations 10, 15 years ago, someone's got Swiss bank accounts, we would really struggle to get that information. Now, the Swiss, along with pretty much every country in the world, exchanges that sort of information routinely, annually, amongst all of the tax authorities. That's just an absolute sea change there. And you may be aware that the OECD has just recently published its intentions around a crypto assets reporting framework. So a similar sort of thing in the crypto space. So big ticket sort of OECD-led international collaboration. But then there's the more day-to-day operational collaboration. We do loads of that. loads of it. We will regularly do things on behalf of the German tax authority. They'll say, can you go and do this in relation to one of our investigations, and vice versa. We'll ask others to do the same. But it's not easy often that, particularly if you're trying to get access to evidence or whatever in other parts of the world. There are some quite clunky systems for doing that. And that's what led me to look to create something that we about 4 years ago, which we coined the Joint Chiefs of Global Tax Enforcement, the J5 for short, as we call it. 5 because there's 5 countries. There's us, the Americans, the Dutch, the Australians, and the Canadians. So 5 are the sort of biggest, pretty capable tax authorities on the sort of tax crime side. And that took a little bit of getting off the ground, but I'm really delighted where that's got to. We're exchanging way more intelligence than we used to. I think it was the first year we exchanged as much intelligence as we'd done in the previous 10 there. We've got a really big pipeline now of intelligence and investigations. The focus right from the start of the group, or one of the key focuses, has been on what we describe as the enablers of international tax crime, international tax evasion. And quite a lot of what I talk about that's in that pipeline, I can't talk about the detail of, it's not got to that stage yet, but what I can do, and you might have caught sight of over recent months, is what we call Operation Atlantis, so Euro-Pacific Bank, a bank that relocated from the Caribbean into Puerto Rico to take advantage of the fact that Puerto Rico is not covered by the International Exchange of Financial Information. It's not covered by CRS. The US doesn't make it do FATCA, so it's a sort of sweet spot there in terms of lack of transparency. And we suspected that bank of facilitating tax evasion, facilitating money laundering around the globe on a quite significant scale. So we have been investigating what's been going on there and the clients of that bank for some time. But I think we publicised an international day of action a couple of years ago where all of us did things on the same day, the same week, and serving notices, raiding premises, arresting people, whatever it be. We then spent a couple of years working through all of that we got from that. And partway along that process, the Puerto Rican financial regulator got interested as well. So we started to share our insight and our learning with them. And a few months ago, they deregistered Euro-Pacific Bank. So what a result. So a suspected enabler of big time evasion and money laundering taken out of business. That's what this is all about. In terms of the tax side of it, we've now got, just looking at the UK side, we think there's something between 600, 700 and 1,000 UK citizens have been taking advantage of the products of this bank. We've got some live criminal investigations, some more to come, good number of civil tax inquiries, and we're now in the process of writing to all the other people who've got accounts and saying that you might want to come talk to us because you had this sort of slightly odd arrangement. Come and tell us what it's about, and we'll work out where we go from there. So that's just an example, I think, of where we've tried to do something to get across that inherent difficulty of working across international boundaries and different laws, different rules, different processes, different languages, different time zones, and all the rest of it. I'll leave it there for now.
Yes, thank you very much for your statements, which were far-reaching already. And I would like to focus on certain aspects, maybe now one after another. Let me introduce the question for quality of data and the need of data for tax authorities by the following statement. In our earlier topic, it was said big failure. Why? The question was asked. Well, if we just think about a tax authority who does not have the overview that 1 million of withholding tax was generated, or the tax authority received 1 million of withholding tax on Finnish or German dividends and paid out 1.5 what did I say, million or billion, doesn't matter, then they are looking into the fog, the tax authorities. How can they recognize problems? So there is a need for data. And I would like to stress that, for example, within the EU, we have the free movement of capital, which in the end allows taxpayers to claim discrimination in a different that they are discriminated against in a different jurisdiction, and that even applies to third countries. So a third country can claim that it is discriminated against. And the reason is that it is economically good to have a unified, a large capital market. Sometimes it seemed, at least in the past, that the data of the national tax authorities available to the national tax authorities maybe did not match with this goal of a treaty that covers what is it, 27 countries now, and actually it applies globally. So maybe what are the initiatives? What is your view on the quality of data that is needed in the context of managing tax globally?
You mind if I start, Kunka, Simon? I think there's a lot to unwrap in your question, to be honest. But if I take it back a step, and I think this links to a conversation Kunka and I had last night around the Beyond Corporate Income Tax Cooperation for 21st Century. That's the G7 paper. In that paper, they talk a lot about compliance by design, which is trying to set up a system so that in the end, taxpayers don't have any decisions to make, but rather they're compliant by the design of the system that's in place. And I think that links well with maybe CARF and CRS and things like that, in the sense that CRS gives us the ability to ensure that tax authorities around the globe are getting the information they need, especially on cross-border investments and things like that. Compliance by design can really help there, in the sense that information is being shared and could, through digitalization and through automation and technology, help taxpayers complete those tax returns automatically using the information that has been shared through CRS. And maybe we can do that on a more frequent basis, not after the fact, but rather live. Now, this is where the complexity comes in, and I'm speaking from the asset management space. If you have a Luxembourg CCAV and you have a UK investor in that CCAV, CRS is going to share information on the income earned by that investor based on Luxembourg accounting rules, during CCAV's rules. That's automatically put into the UK investor's UK tax return. That's not necessarily the correct taxable amount for that UK investor, because you have to have UK reporting fund status tax calculations taken into account. So the idea of compliance by design is a really lofty goal, and one that we should aim towards. But the nuances across industries, and I'm speaking from the asset management space, can complicate that. And often from the asset management space, it's a smaller space. It's not always taken into account when those designs are first made. So definitely opportunities. I see challenges to how we can implement those type of things as well.
I mean, firstly, just to agree, data is key. Data is a huge part of what we need to carry out all sorts of aspects of our job as a tax administration. And we have loads of data in HMRC. Probably the most data-rich organisation in the UK, I would suggest, and we have all of that in some quite sophisticated technology that helps us build a picture of individuals or corporates or whatever it might be. My end of the market, intelligence is also key, as well as data. Now let me explain what I mean there by reference to a couple of things we've already touched on this morning. So CRS, the mass data we get from CRS has been hugely beneficial in its identifying where perhaps people haven't returned overseas bank interest that they should have done, or to nudge them to say, are you sure you haven't done this? And we've seen a real change of behaviour, particularly those people who perhaps were just a bit confused or didn't know they had to do this. So really, really good. But where there are people doing very, very deliberate and very sophisticated things, CRS data alone is not going to unearth that. And that's why we need intelligence and really understand what's going on. The other way, just to go back to the CumEx type example, you talk about the massive data that you'd have to be able to put together to realize that's happening. The other option is someone comes and tells you it's happening. You know, so when whistleblowers, we pay someone some money to come and tell us that's the thing. So the intelligence side of it is really important as well. But the one other thing I'd like to highlight, which is something we're very active on at the moment, both domestically and with the J5, is working with the financial sector to see what we can do collectively to prevent and detect tax crime, tax fraud, tax issues. The private sector often gets to see things first. They will see, particularly the financial sector, will see transactions that won't have come across our radar at all by that stage. Equally, so we want to know about that. Equally, we can provide banks, financial institutions with help on what they should be looking for. And we found that work really well via the UK GIMLIP system, which has got a tax evasion cell in it as well. So we relatively recently gave them some stuff on what we call payroll company fraud, but also some of the tax on the self-assessment system. And the banks were able to freeze assets. They were able to spot things that we hadn't seen before. So that collaboration between public sector tax administrations, private sector, particularly the financial sector, we're seeing things in real time as they happen using their sophisticated transaction monitoring tools is a really big opportunity, I think, to do better and quicker and more informed.
I think that I will go back to the two pillars again. I mean, the whole work of these two pillars has basically highlighted the importance of those international corporations on tax issues, but not only at the political level, but also with respect to practical questions of tax administration that will also hopefully help us facilitate the implementation of the agreement. And this is the reason why we, during our G7 presidency, we asked the OECD to prepare a report on this topic, the report that Paddy mentioned, namely the report on the further strengthening of the international tax cooperation, including certain recommendations for further action. And for us, this was a very good opportunity to rethink cooperation among tax administrations and the interactions between taxpayers and tax administrations. And for example, if you look at Pillar 1, Pillar 1 relies on common rules and tools, which really call for a coordinated administrative process. I mean, Pillar 1 even includes a novel multilateral early certainty process for the whole administration. And this has the potential to change the way countries view the administration of common international tax rules, because it might be beneficial for all stakeholders. I also believe that Pillar 1, for instance, will help us go digital sooner. For example, via efficient digital communication channels that permit the submission of documents and interactions with taxpayers, while at the same time maintaining data privacy and taxpayer confidentiality, which you know that is very important in Germany and it's very complicated. I mean, countries will need to engage in the development of the necessary digital tools and platforms that will be important. And in this respect, a particular focus should be really on facilitating the international exchange of information and creating a common framework for multilateral tax audits as well as tax certainty processes. Yeah, I mean, in that context, I believe that governments are facing the challenge of taking into account the need for a common and compatible multilateral solution, while also meeting the data protection requirements of the participating jurisdictions. And probably we might even be able to introduce a very standardized information reporting and single filing that will also significantly reduce the compliance burden on taxpayers. And if you're really optimistic, and I try to be optimistic, maybe we will be even able to develop a collaborative approach with some form of central project management and a very active role for the taxpayers. So many challenges, but also opportunities. So in every reform, there are many opportunities as well.
I would like to come back to the free movement of capital because I think it's very special. It's very much a special feature of the common market in the EU. I think it enables the financial services industry to build a huge market. If it doesn't come with responsibility, maybe it could it could be withdrawn for whatever political reasons. So, and I hear from you, Dr. Petkova, and also from you, Mr. York, that there is a will to cooperate on the side of the tax authorities. So maybe it could also be an idea, more so than in the past, at least of the financial services industry, to actively look for such cooperation. With the different tax authorities. I mean, they have to do their job also, but responsibility without liability can easily, be misused. And so, this is my thought now here. I would think it's a value to be preserved, the free movement of capital, but it could also be lost. Mr. York, I was surprised that you said, if I understand correctly, 5,000 people within the HMRC's tax administration are working on fraud investigation.
Yeah, and that's serious fraud investigation. There's a lot of other people working on sort of perhaps lower level tax non-compliance, which might include an element of evasion, but tackling organized crime, tackling serious fraud, tackling serious evasion. I've got 5,000. Yeah, mixture of criminal investigation investigators, tax experts, forensic accountants, cybercrime specialists, insolvency specialists, post crime specialists. Real blend of sort of whatever we need really to throw at the problem.
And if we think about our topic, manage tax globally. I mean, maybe you cannot say this, but how often is it international? How is it usually local UK fraud, or is it?
I mean, with the UK's tax authority, so we're dealing with, in the main, situations where we think it's a UK tax that hasn't been paid, but almost every investigation has got an international aspect. So if it's smuggling, obviously it's coming across borders. If it's involving any element of moving money around the world to either hide it or launder it or take other sort of advantages from it, and there's that offshore aspect. We get some people who are based overseas targeting the UK tax system. So we have all of those sort of scenarios going on, and I would say the majority of what we do has some sort of international element, and some of it has a huge international element. And the work of the J5 there is trying to get to those situations where the whole thing revolves around something that probably doesn't sit in any of our jurisdictions, but is facilitating, what's happening in all of them. So very, very complex work, really, which is why we've got the 5,000 people, I guess.
And do you have an overview whether other tax administrations in other countries have comparable capacity as the UK?
They're all a bit different. And often they have different responsibilities, if you like. So the UK's my part of the UK's tax authority is a full fat law enforcement operation. Okay, so we have all the powers of the National Crime Agency, which all derives from the old days of customs, where we used to do the drugs enforcement and the smuggling and all the rest of it. So we've still got all of that, as well as all the tax, the tax powers. Some tax authorities around the world have exactly that. Some of them don't. So it's a real mixture. Of the most developed tax authorities, I guess most of them are in that sort of league. I think the UK is really well resourced.
Yes.
You could always use more because there's so much happening. But when I look and I speak to my colleagues around the world, I think honestly we're not too bad here, actually.
I don't think it's that quality in Germany yet. Mr. Kazimi, you would like to ask a question?
Sure. So, Chair, I just have to remind that we're running over time. That's one thing. But with that, I will ask a question before we close the session, which is to Patrick. I mean, we've heard particularly from Kunka, a brave new world full of opportunities and things like that. I don't quite hear that from my clients, but I would ask Paddy if he wants to say, you know, do you see it as a world full of opportunities, that things are becoming global and so on? I mean, from a resourcing, from a risk perspective.
I think the increased complexity obviously has its challenges, and those challenges mainly lay around risk. So you need to define where that risk is and what your risk appetite is. Within our particular organization, we're extremely risk averse, so that creates its own challenges in the sense of resourcing. So when you're looking at resourcing, then you have to think about, is it resourcing in-house? Do you need to add to your team? Do you need new skill sets within the team? Do you just need more people? Or how do you use your service providers, your outsourcing providers? And then that kind of brings about another question around, well, where then is the risk? Is there contractual risk that you can outsource, but really that's still, the risk still remains with the fund, for instance, in our case? Or what are the risks involved with actually outsourcing that? Do you have a different type of thing that you need to manage because you're not day-to-day overseeing it? So that's where you have to build that relationship with your service providers, find the right ones, find the right people in each jurisdiction in which you actually have that risk. So I do think it presents a lot of challenges, but at the same time, those challenges are worthwhile in the global scheme of things when we're looking at what are we trying to address here. And this is tax integrity, tax transparency, making sure the right people are paying the right tax in the right place. So in a sense, as a tax professional, you understand the goal. And so while it brings challenges to you to actually be able to meet those needs, I think it's beyond the point. I think the point is we're going in the right direction. We'll do our best as the industry to try to help get there. But yes, it's going to provide challenges. And this is when I come back to my original point about kissing the Blarney Stone. You need that element of persuasiveness within your own organization to elevate tax to where it should be. And that's kind of all throughout the organization. I hope that answers your question, but the best I could do there.
So managing tax globally is a very wide area. We tried to give you a bit of a flavor today. Thank you very much for your attention. Thank you very much to Mr. York, Dr. Petkova, and Mr. Reidy for joining and for your contribution here today. And we hope to see you again next year with certain aspects of this. Thank you.